Hyperinflation, a term that has risen from the dead. What was once only talked about in textbooks and classrooms has now become mainstream news. After injecting trillions of dollars into the economy, the United States is finally feeling the effects of money printing as prices across the board are skyrocketing to new highs. These changes in the economic landscape have become too obvious to ignore, and finally the topic of inflation is back into the mainstream. While the Fed currently publishes a stat that is rather laughable, claiming that inflation is a mere 2.5%, the American consumer is waking up to a new reality, where all things are getting more and more expensive by the day. This has sparked a new conversation with people in two separate distinct camps. On one side, you have the Federal Reserve. While they're finally admitting, quote, small inflationary pressures, they claim that these pricing pressures are temporary, or as they like to call it, transitory. Their take is that because of immense pent-up demand due to the pandemic and the various money injections done by them, inflation will go away as soon as supply catches up to this extraordinary demand. Powell is often quoted that he isn't even thinking about raising rates. Take a listen for yourself.
You've been hearing, of course, these concerns raised by Larry Summers and others about inflation, and the fact that they think the Fed might let things get out of hand with the new policy stance. So my question is, can you tell us what is different this time versus previous periods like in the 60s when inflation got out of control? Why are you confident with the lags in monetary policy that the Fed can get ahead of inflation and make sure it doesn't go too far above the 2% target?
Your question. So I actually have a couple of things I'd like to say about inflation, including addressing your question. So let me start with just saying that we're very strongly committed to achieving our objectives of maximum permanent employment and price stability. Our price stability goal is 2% inflation over the longer run, and we believe that having inflation average 2% over time will help anchor long-term inflation expectations at 2%. With inflation having run persistently below 2% for some time, the committee seeks inflation moderately above inflation for above 2% for some time. So with a little bit of context, we're making our way through an unprecedented series of events, really, in which a synchronized global shutdown is now giving way to widespread reopening of economies many places around the world. In the United States, fiscal and monetary policy continue to provide strong support. Vaccinations are now widespread, and the economy is beginning to move ahead with real momentum. During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why. But those pressures are likely to be temporary as they are associated with the reopening process. And an episode of one-time price increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation.
As you saw in that carefully crafted, prepared statement, Fed Chair Jerome Powell was very careful choosing his words. The Federal Reserve is facing a huge dilemma. It's actually against their interest to admit to any inflation past 2%. This is not some sort of conspiracy, but rather an assumption based on real facts. You see, if the Fed admits to any amount of significant inflation, it will cost the government billions of dollars per year. Take for an example Social Security. Benefits are adjusted for the effects of inflation using the cost of living adjustment. Each year, the Social Security Administration decides whether the following year's benefit payment will include a cost of living adjustment, and if so, how large it should be. Programs like this would face significant pressure if they were to admit to any number above 2%. If you look at history, one thing central banks have done to fight inflation successfully is raise interest rates, and based on how markets have behaved in the past to a rate hike, you can bet that there is a good chance that stocks will collapse even if a small change were to occur. Just a small little comment hinting at a rate hike from Secretary Yellen last week was enough to cause markets to fall significantly. So what is the Fed's plan going forward? Well, Mr. Powell's theory is pretty simple. Inflation is just temporary, and as soon as we open up the world, things will cool off and prices will stabilize. This is a big if, and too many people think it's a big lie. Take for an example Peter Schiff, who had this to say about that theory.
Well, the markets continue to ignore mounting evidence of a huge inflationary problem because everybody is convinced that these price increases are transitory, right? It's all temporary. It's all the result of comparisons and other anomalies that were associated with the coronavirus and the shutdown. And so we can close our eyes to what's plainly there because we can all rest assured that this is just transitory. And again, the principal leader in this "it's transitory" campaign is the Federal Reserve, is Jerome Powell. And after all, if the Fed thinks it's transitory, well, who are we to argue? But again, it was the Federal Reserve that said the problems in subprime were contained, and now they want us to believe that the problems with inflation are transitory. Well, they're as transitory now as subprime was contained. The problem is the markets are being fooled again, just like they were being fooled in the past. And the new evidence that everybody is ignoring that was out earlier today was the big jump in import and export prices. And this follows the big rise in consumer prices that we got yesterday. In fact, let me start with the March CPI.
Now you may be thinking, well, Schiff has been pretty bearish on the market since about 2010, and that is a rather fair analysis. But this time he's joined by many other prominent investors who actually agree with him on the inflation argument. Take for example Michael Berry, whose tweets in March suggested that the United States is headed towards a serious inflation crisis before he went completely silent and deleted his account after a visit by SEC officials. We know from previous disclosures that Berry was investing in things like farmland, water, and other commodities that would benefit from a scenario where the dollar loses significant amounts of value. His tweet from February referenced the infamous 1980 Warren Buffett letter to Berkshire Hathaway shareholders, where Buffett explained that high rates of inflation act as a tax on capital, discouraging companies from investing by reducing their real returns. Berry dredged up the letter to emphasize that if inflation ramps up, corporate profits today will be far more valuable than profits in the future. The now deleted tweet stated taking Buffett's lessons from 1980 and porting them to 2021 doesn't take much translation. If high inflation occurs, each dollar of earnings today becomes more important as earnings 10 and 20 years from now may be worth substantially less tomorrow than today. This is obviously going to impact those high growth companies that base their evaluations on future returns. But what are the chances of this? In the past, the United States has really only experienced two periods of significant high inflation, once in the late 70s and early 80s, and once in the post-World War II period. We're going to ignore that post-World War II period in this video as it was a rather special event that you can read about on your own time. The US had just come off a massive war and was in the middle of taking over the world, rebuilding Europe and Japan. We will instead focus on the late 70s, which as you may not know was considered a rather troubling period in the United States. On top of the growing inflation concerns, we had high unemployment, slow economic growth, and recession. The reasons why can be explained by this interview with former Philadelphia Fed CEO Charles Posser. Take a listen.
The U.S. faced nearly double-digit inflation for quite a while. It rose from 2 or 3% inflation in the late 60s, rose up to 4%, then to 6%, then to 8%, then to 10%. People thought that the cause of the inflation was oil prices, but in fact it was monetary policy. We kept trying to lower the unemployment rate because that was part of our mandate. But in fact, all we ended up doing was raising the inflation rate.
The ascendancy of Paul Volcker to the Fed chairmanship really changed this situation. Volcker was determined to clamp down on inflation, which he did.
Sound familiar? Right now, inflationary pressures are instead being blamed not on an oil price hike, but the pandemic and the subsequent pent-up demand we are experiencing. Countless officials are ignoring the trillions of dollars that we have printed in the last 16 months, repeating over and over again that these price hikes are only temporary. Eventually, just as it happened in the 70s, the Fed will have to admit defeat. The only question remaining is, will it raise rates like Paul Volcker did? Remember, doing so will undoubtedly crash the economy, exchanging temporary pain for long-term health. But given the current political climate, it's very hard for a politician or a Fed chair to come to this decision. Back in 1979, the man literally came out and publicly stated that, quote, "The American standard of living must decline. claiming that Americans must accept a reduction in their living standards if inflation is to be reduced. Can you imagine Jerome Powell saying something like this today? This is why the chances of hyperinflation are so much higher today, in my opinion. Unless we get a change in public perspective, no politician or economist will ever make those harsh decisions, but instead will hide inflation figures, downplay price pressure, and use the hope and pray strategy that we somehow get out of this without ruining the US dollar. If we take a look at recent decisions and the future outlook on monetary policy, it doesn't look like we're going to be putting a cap on spending and money printing anytime soon. So while I titled this video rather dramatically, I believe it's a valid concern for the future. With out of control money printing, crazy price spikes, and weak politicians who think short term, in my opinion, the inflation bomb is armed and is waiting for a spark to light the fire. The next year will be incredibly interesting to observe as America goes through this period of, quote, recovery. Thank you guys for watching, and as always, please make sure you hit that subscribe button if you're enjoying my content.